Hey everybody, how's it going? Did you know that dividends were first used centuries ago? The practice of companies paying dividends actually started around the 16th century. The Dutch East India Company, one of the world's first multinational corporations, paid regular dividends to its shareholders. 5 centuries later, dividends continue to be sought after by investors who want to put their money to work and get a regular income. Today, we're looking at 3 different dividend stocks that can provide you with a good, steady income. Without further ado, let's jump right in. The first stock that we're looking at is Air Products and Chemicals with a symbol of APD. APD deals with essential industrial gases, related equipment and applications expertise. They have customers all over the world in various industries that include anything from refining, metals and electronics to medicine and food. APD also design, build and operate some of the world's biggest industrial gas and carbon capture projects, which supply clean hydrogen. Plus, the company has leading positions in markets like helium and liquefied natural gas process technology and equipment. Overall, APD has a stable and growing business, plus high exposure to the clean hydrogen sector, which is expanding rapidly. In fact, APD is the first company to start developing mega-scale green hydrogen projects, so we can see that this is a significant strategic focus. Now, APD's last earnings release showed slightly higher than expected earnings and revenue. Earnings per share came in at $2.74, $0.08 above expectations and 15.1% higher than last year. Revenue came in at $3.2 billion, $121 million above expectations and 8.4% higher than last year. APD also raised guidance for the rest of the year. The company now expects earnings per share of $11.3 to $11.5 versus the analyst consensus of $11.38 and 10 to 12% higher than last year. Analysts expect that the compounded earnings growth for the next 3 to 5 years will be 11.4%, which is really good. Unfortunately, APD does have a high forward PE ratio of 25.8, which gives us a price to earnings growth ratio of 2.26, which is not that cheap. The company's dividend yield is also currently 2.5%, which is not the best. It is above the sector median for industrial gases, but remains a bit low for the US. On the bright side, APD does have a solid dividend growth track record. The company has raised dividends at a compounding growth rate of 11% over the last 3, 5 and 10 years, which makes it a good pick for long-term dividend investors. Going forward, analysts expect that the dividend growth rate will be about 4.5% annually. Personally, I find APD tempting for 3 reasons. One is obviously the earnings growth, the second being the dividend growth. However, the third and main reason is APD's exposure to the clean hydrogen industry, which is becoming very important. I think this is the reason why APD has a bit of a price premium. Plus, the company has steady financials. Despite a long-term debt of $9 billion, the company has $2.5 billion in cash, which is more than enough to ensure financial stability. Accounts receivables are also almost twice as much as accounts payables, so it doesn't seem like APD is expecting any financial trouble. Overall, the company is a solid pick, although it is a bit expensive. Ideally, I want to see the company at $230 to $240 before I open a big position, but I think that APD is definitely worth following. The company has plenty of potential and a bright future. The second stock we're looking at is Cisco, trading under CSCO. I have talked about Cisco before, and there's a good reason why. Cisco is a solid, established business with a steady free cash flow and a good dividend. The company is a leader in networking and communications hardware, wireless, cybersecurity, and a lot more. The earnings release on the 17th showed why Cisco is a good pick. Despite being seen as a boring company by some investors, Cisco delivered their best earnings ever. EPS came in at exactly $1, beating expectations by $0.03. The revenue of $14.57 billion also beat expectations by $212 million, as it increased 13.5% year on year. In addition, management raised outlook for both revenue and earnings. The revenue for 2023 is now expected to rise between 10 and 10.5%. Earnings are expected to go up by $3.8 to $3.82 per share, compared to $3.36 last year, an increase of 13.3%. It should come as no surprise that all the analysts have been raising their expectations too. We have seen 19 upward revisions in the last 90 days and 0 downward revisions. Such a spike in upward revisions is usually correlated with increased stock price, so this could be a bullish indicator for Cisco. Plus, long-term debt went down, total outstanding shares went down, cash reserves went up. The current dividend yield of 3.18% isn't that big really, but it is twice as much as the sector median. Not to mention that Cisco's dividend is also high quality and well covered by their free cash flow. Plus, Cisco have had 11 consecutive years of raising dividends. The average expected dividend growth rate is not that high, standing at only 2%, which is not great but is sustainable. Plus, Cisco has more cash than debt and is even making some extra interest income. Overall, Cisco continues to perform well and I will continue to buy the stock. A lot of people don't think that Cisco is a groundbreaking stock pick and don't see a lot of return with it. I get why they think so, but I still consider Cisco a dividend stock pick with a good potential. It can stabilize your portfolio, it is a stock that you can depend on during tough times in the economy. There is a lot more that I can say, but if you want a more in-depth analysis of Cisco, you can check out the video in the top right or in the comments below. Tyson Foods is one of the biggest food and meat producing companies in the US and worldwide. The business has 4 different segments: beef, pork, chicken, and prepared foods. Tyson Foods are known for poultry products like chicken nuggets, buffalo wings, tenders, and so on. It's a pretty straightforward business. Now, Tyson Foods released earnings for Q2 of 2023 a couple of weeks ago, and they were bad. Actually, not just bad, they were disastrous. Tyson Foods reported earnings of negative $0.04 per share, compared to the expectation of $0.8. Tyson Foods revenue also missed by $484 million and came in at $13.13 billion. The stock price tanked naturally, and Tyson Foods currently trade at $50. The cheap price has made a lot of investors start looking at this dividend stock. So have I. It does look like Tyson Foods offers a good return as a dividend stock at first, but is this misleading? Possibly. I personally think of Tyson Foods right now as a turnaround play. This is the label that Peter Lynch gave to companies who are going through tough times and are trying to turn things around. Now, turnaround plays are risky inherently, because there is always the chance that the company will not succeed. Tyson Foods is currently facing a decrease in beef and pork revenues, along with a massive drop in margins compared to last year. Live cattle cost went up, hurting the margins in the beef sector as the supply tightens. Lower demand for both beef and pork meant that sales fell a bit. High inflation also resulted in higher operating costs for beef, pork, and poultry segments. The poultry segment was specifically affected by higher feed costs, which hurt the margins. Overall, it looks like the company had a challenging Q2 and will continue to face a lot of challenges throughout the year. Management has also signaled that Tyson Foods may take on a bit of extra debt and push their leverage up a bit. It won't be much, but this is not a great thing to hear when the interest rates are at the highest point in 15 years. This resulted in management increasing the expectation for interest expenses from 330 to 340 million. Obviously, seeing all of this does not really inspire a lot of faith in the company. The dividend yield of 3.84% is good, but I'm not sure that it provides enough compensation for the risk. On the bright side, Tyson Foods has a tremendous compounded dividend growth record of 12.4% over the last 5 years. The company is only expected to grow its dividend by an annual rate of 6.7% over the next 3 years, which makes sense given the current challenges. Overall, I don't think I will be opening a position right now in Tyson Foods, but I am keeping a close eye on the stock. Like I said, Tyson Foods is a turnaround play, and I personally think that it can turn into a very profitable opportunity later on in the year. However, patience here is essential. There is little point in buying the stock unless we see the outlook for it changing. So, what do you think? Are you a fan of Cisco, APD, or Tyson Foods? What are your top dividend stock picks right now? Let me know in the comments below. If you enjoyed this research, drop a like and share it with your friends. Thanks for watching, and I will see you again in the next one.